Hi, and welcome to this week's The Mortgage Broker broadcast. I'm your host, Craig Skelton, and if you are a returning listener, you'll know that this show is for self-employed mortgage brokers and business owners who want to build a sustainable business. Each week, we talk about mindset, habits, and the practical realities of running a mortgage broker business. Last week, I sat down with Jonathan Needham to discuss the FCA's policy statement PS 25/11. It's a very detailed document, and one of the headline changes is the removal of the so-called advice trigger. I'm not going to get technical this week on the podcast, and if the policy is of interest to you, then I suggest reading it in your own time. But Jonathan and I just didn't talk about the rule changes. We explored what that means for mortgage brokers and their mindset. If the world of mortgage broking is becoming more flexible, how should brokers evolve? Our conclusion was simple but very powerful. Start thinking like a financial advisor. So why does this change the game? Well, removing the advice trigger allows brokers to have open conversations with clients without immediately making recommendations. Consumers can talk through options without it automatically becoming formal advice. That's good for access, absolutely, but it also puts more responsibility on you. And this is where your skill and mindset matter most. If you see yourself merely as a product selector, shall we say, and not an advisor, you risk missing the bigger picture. Thinking like a financial advisor means understanding the client's overall financial situation and guiding them accordingly. And that also fits neatly with consumer duty, which requires firms to deliver good outcomes and avoid foreseeable harm. So, what does it mean to think like a financial advisor? Let me be clear. I'm not suggesting you start advising on pensions and investments if you're not authorized to do so. A financial advisor is a professional, like a mortgage broker, absolutely, but a financial advisor is a professional who offers comprehensive guidance across investments, retirement planning, tax planning, as well as sometimes mortgages and protection too. They take a holistic approach to financial planning, whereas the mortgage broker focuses exclusively on mortgages and related products, which is generally protection and general insurance. Because financial advisors have such a broad remit, their depth of knowledge in the mortgage market isn't always as extensive as that of a specialist, you, a mortgage broker or a mortgage advisor. That's why clients still need you. But what we can do is borrow from the financial advisor mindset, is that holistic thinking. Rather than treating the mortgage as a one-off transaction, we need to be thinking about long-term goals. Financial advisors start with clients' ambitions, such as retirement age, future plans, lifestyle aspirations. When you ask your clients about their 5 or 10-year goals, you understand more about them and whether they need flexibility, and whether downsizing is on the cards, or maybe moving home, or anything else that's part of their financial aspiration. It's also about protection and risk management too. Financial advisors look beyond the mortgage to ensure that the client can keep their home if something goes wrong. This means they will look at protection products just like you. However, many borrowers still have a mortgage debt without adequate protection. Why is that? Generally, the financial advisor is focused on pension and investment aspect. So you can fill that gap if you have a great relationship with a financial advisor, because they don't have time to talk about mortgages. They don't have time to talk about protection. But one thing they do is talk about budgeting and cash flow. Financial advisors often build cash flow plans into part of their advice. So I'm not sort of saying you don't need to create complex models, absolutely not. But you can help clients understand how overpaying on their mortgage or extending their term impacts their monthly budget. You can use that to your client's advantage. Show them how shaving off a few years can save like tens of thousands of pounds in interest. That's all part of what a financial advisor can do. I'm not saying you don't do that right now, but we need to be switched on more as a mortgage broker to be thinking that way. Which also comes on to referrals and partnerships. If a client needs advice beyond your scope, investments, pensions, estate plannings. As I've said before, you need to be partnered with a trusted financial advisor, a trusted financial planner. Financial advisors don't do everything themselves either. They know when to bring in a specialist, and that specialist, from a mortgage point of view, could be you. By building a network of Complementary professionals enhances your service. So, how do you embed this thinking into your day to day process, into your day to day habits? First thing to do is begin with that initial conversation with your clients. When your client contacts you or you're completing a fact find, instead of getting straight into mortgage rates, terms, budgets, ask broader questions. What are your long term goals? Are there any major life events coming up? How secure is your income? Get to know their full financial picture. You may discover that they're planning to start family or switch careers or care for aging parents too. These insights can affect the mortgage solution that you recommend. And then we need to reframe the remortgage reviews as holistic reviews. As I've said before, there's like 1.8 million deals set to expire this year. 1.8 million remortgages due. That's a huge opportunity. Rather than just simply switching rates, schedule a full annual review of the client's financial position. Discuss any changes in their income, expenses, dependents, appetite for risk. If they have spare income, considering whether shortening the term makes sense for them right now. And if cash flow is tight, then talk to them about lengthening the term, which will ease that pressure while you help them build in a rainy day fund. And you need to put protection on the table every single time. Many advisors skip that awkward conversation about protection because they fear it's sort of salesy. But the industry still suffers from a protection gap. You need to remind yourself that helping clients protect their mortgage is part of delivering good advice, delivering good outcomes. And if you don't want to handle the product protection yourself, that's absolutely fine. Just make sure you refer to a specialist. But raising the subject demonstrates that you're thinking beyond the transaction. When a client feels you generally care about their welfare, loyalty increases and referrals will grow. And it's okay to educate about these services while you are remained focused on mortgages. Absolutely. Understanding how pensions, investments, and estate planning work will allow you to spot opportunities and risk too. Like there is plenty of CPD out there and industry webinars too that will help you with your education on these products. And even without giving regulated advice, being able to speak the language of wealth management will make your conversations richer. And also use technology. A good CRM isn't just about case management tool, it's your memory too. Use it to record clients' long-term goals, protection needs, upcoming life events. By combining these tools with a human touch, you can deliver personal yet scalable advice. I've talked before about setting reminders to check in with clients every 12 months. Absolutely. But also like scheduling things like about how the new job's going or how the kids are getting in at the new school. All those kind of things build loyalty and trust with your clients. And automating that frees you up to focus on the relationship. So why does this approach matter now? Well, the mortgage market is changing fast. The regulator is telling us that open conversations without immediate advice should be possible, but clients still need guidance. Lenders can now process remortgages more smoothly, but meanwhile, the consumer duty sets a higher bar. Firms must act to deliver good outcomes and avoid causing foreseeable harm. Thinking like a financial advisor aligns with these expectations. But there is also a business need. In a competitive market, your edge just isn't about rates, it's about the trust that you build and the breadth of problems that you solve for your clients. If you only talk about mortgages, you are at risk. If you demonstrate that you understand your client's financial journey, you become indispensable. And let's not forget about opportunity referrals too. Financial advisors often send mortgage business to brokers because they don't specialize in that area. The same can work in reverse when you adopt a more holistic mindset. And let's talk about mindset and well-being. Adopting this broader perspective doesn't mean in working yourself into the ground. In fact, it can embrace your well-being. When you focus on the bigger picture and serve clients more comprehensively, you reduce the feeling of chasing transactions. Knowing that your role is to guide clients towards financial security, not just to secure a mortgage, can be very, very motivating. So that's it. That's this week's podcast. What are the key takeaways? Well, PS25/11 removed the automatic advice trigger, making it easy for consumers to discuss mortgages without counting it as formal advice. Think like a financial advisor, not because you're giving investment advice, but because holistic thinking leads to better outcomes. Understanding clients' goals, risks, cash flow, and not just the size of their mortgage. Use your annual and remortgage reviews as opportunities to explore the bigger picture. Use these touch points to discuss protection, budgeting, and future plans. And record what you learn and act on it. As I said, a CRM can capture goals, life events, protection needs, but it's all down to the conversation that you have. Combine technology and genuine curiosity and invest in your own education. Consider, if you want to, additional qualifications or partnerships to expand your understanding of investments, pensions, and estate planning. And wrapped around that is protecting your own well-being. Holistic approach can reduce the transactional treadmill, shall we say, that mortgage brokers can suffer from. And if you take nothing else from this episode, the one thing is the mortgage market is moving towards flexibility and openness. Clients will expect you to guide them through more than just interest rates. By adopting a financial advisor's mindset, you'll provide deeper value, build stronger relationships, and future proof your business. So that's it. That's this week's Mortgage Broker broadcast. And just before we close out, a reminder of our non-cast to AR Academy. If you're an aspiring mortgage broker, aspiring mortgage advisor who wanted to become competent and ultimately run your own firm as an appointed representative, then that program is for you. We provide training, mentoring, community, and real world experience to take you from CMAP and theory to practice without all the bull and without any nonsense. If you are interested, send me a message, connect with me, and I'll explain more of how this works. Thanks for listening. Thanks for watching. If you found value in this episode, please subscribe, please leave a review, share it with another broker. Don't lose sight of why you started this in the first place. Building a business that reflects your values, serves your clients, and supports your life. As always, run your own race, and I will see you next week.